Welcome to the show, everyone. Today we have a special guest. His name is Dan Rohinton. He's a VP of Portfolio Management at IA Clarington, and he oversees three dividend funds there, the global, Canadian, and U.S. dividend funds. Dan, thanks for being on the show.
Thanks for having me, Ron.
So what prompted this really was your brilliant post on LinkedIn, and the post is on BCE, Bell Canada stock. Tell us what the heck's going on there with Bell Canada, Dan.
So, it's if we really take the conversation in a narrow lens first, and then we broaden it out to something I think is a little more symptomatic of the broader Canadian market. The narrow lens is BCE and the other telcos more broadly, but BCE is a perfect microcosm of this. They've actually benefited from, generally speaking, high levels of population growth in Canada, which made the environment a bit more constructive and a bit more friendly. So even though they were going through capital intensive spectrum purchases and the like, there was still an upward trend to participate in. So the tide was rising. Now, as some of those headwinds are starting to pile up, and telcos as an industry tend to be quite competitive, where the economic rents don't end up staying with the telcos itself and goes to consumer surplus, BCE flinched, and frankly, they panicked. The flinch, I actually don't think it's a bad idea that they did this initially, was they sold off the MLSE assets, which they own their
All of
stake
them,
in.
100%, the 100% of their stake, right?
Yeah, they're done their full stake basically now. And it was highly valued, and it opened up capacity that they could do two things with. They could buy back stock or they could delever. Both perfectly acceptable options in my mind, and frankly, what the market was expecting them to do. But what ended up happening was a surprise to, frankly, all of us and a shocker, because what they did was they took the cash flow and then they pre-committed to several more years of cash flow in building out U.S. fiber on the West Coast. And we can go into a long, deep conversation about why Canadian telcos don't have any business being down south and vice versa. But it's a binding deal. They can't get out of it, no matter how much the market hates it and pressures management, which they are. It's a binding deal. And when you think about what the assets were, it's primarily a fiber footprint, and then they're going to build out more, which is going to mean that BCE up till 2027 is going to be committed with building out fiber in basically the Pacific part of the U.S. And there's nothing inherently wrong with that. Fiber is a terminal state type of delivery mechanism for data. But, why does a Canadian telco have a right to win in one corner of the United States when AT&T, Verizon, any of the other, and T-Mobile, let alone the cable operators, which have been overbuilding each other's footprint for a while now, there's no business that BCE has in that conversation. So you took what was trophy assets that can't be replaced in Canada and recycled that capital. You took those trophy assets, you sold them for trophy multiples. Good for you. Gold sticker for that. And then he went to the reddest ocean that money can find anywhere in the U.S. market, and you said, "Hey, we have a right to win there too." Now that's fundamentally the gripe, and why BCE shareholders, not quite openly revolted, but really showed their dissatisfaction with the deal, with just how poorly the stock is done. Because it's not just that you overpaid or even paid a full price against what is a private equity-backed asset. You then committed your capital, which is scarce, and it's an incrementally more competitive market in Canada. So you took cash flow pressures and pre-committed any cash flow you had at the margin to building out U.S. fiber in the hopes that you'll get big synergies there. So it's the misallocation of capital and, generally speaking, the deteriorating fundamentals of the Canadian telcos that led to this perfect storm. Which, if I may ramble a bit more, Robin, the question that comes to, well, that's cool, Dan, but the yield's 12%. So that's okay. The issue with that is that it's not really that okay, because they're actually using what's known as a dividend reinvestment plan, which sounds nice, and the marketing team did a great job there. But really what it is it's a backdoor equity raise with the dividend. So about usually drip take-ups can be about 30% or so. So 30% of the yield is actually recycled in to raising more equity to fund U.S. fiber build-out. So my point with Canadian companies, generally speaking, is Canada's great. Stay at home. You don't need to go down south. As global portfolio managers, we can make that decision for clients on our own. So we don't need a management team that's specialized in Canada for decades to then decide to go south of the border and try their luck.
And the street has absolutely punished Bell Canada stock, BCE. If anyone searches up today, this is almost the end of December. It's at $34 per share. As you said, 12% dividend yield. And is a 12% dividend yield sustainable? So if someone goes in and thinks, wow, like a 12% I can add to my dividend income, is now the time to buy?
You know what? At this point, it's probably getting to a point where the dividend cut is realistically priced in. So I would say don't think it's a 12 yield, think it's an 8.5 yield as a realistic cash flow yield that you're getting out. So the valuation has come in. I would be an incremental buyer here as opposed to a seller. But it's important to remember what our starting point was. We were here in January at $55. We're at $33. It's now I can say it's probably priced in, and the dividend cut should be on the table and should be my base case scenario from here. The magnitude is the open question, but the dividend cut, it's already starting to get priced in. So I think it's incrementally a time to add, but I'm not buying a 12% yielder. I'm buying an 8% yielder that's diluting me slowly. And I have to discount the fact that they have misallocated capital with a major transaction, and the Canadian fundamentals are getting worse, and the subscriber growth is going to slow down from where we are today. Yeah. And that assumes that Quebecor is going to ease off a little bit from trying to grow the Freedom brand after the Rogers Shaw deal.
It's such an important lesson, right? I think for people who are looking to invest in dividend stocks, they must understand when it looks too good to be true, the yield itself, when it's so high, that a cut might be coming, and look further into the company and do your due diligence. On the topic of capital allocation, right, Dan, what should Bell have done? What could they have done? What other areas could they have deployed that capital in a better way?
It's tough because at some point, the question for the telcos in Canada is they were definitely aggressively priced when they were in the low 20s and high teens on the multiple in the first place on PE, just as a simple heuristic. So they were already, the market kind of took you there in the first place. But what Bell realistically should have done is they should have sold the trophy asset. So good on them for that. But they should have recycled the capital into either a substantial issuer bid or a delever. And then just frankly focus on optimization, because you can't control that subgrowth and population level growth is slowing down. But you can try to control where your relative spend is going on. So they should have just spent more time on optimizing their cost structure, improving that, and defending margin as top line was slowing down. So they could have built a, call it high yielding equity type of bond with strong visibility if they'd done a substantial or delever. But I acknowledge that there's no silver bullet here. Sometimes the fundamentals of a business are just getting worse, and management is just a beta driver up or down to the positive and to the negative. In this case, unfortunately, it was to the negative.
And I love how you worded it, right? Basically, it's BCE management putting coal in the stockings of shareholders right before Christmas, leading up. So there's a lot to be said here. There's also buybacks, right? I think you also mentioned that in your post. That could have been, an easy avenue. Yep. To increase the level of buybacks with the capital. You oversee those three dividend.
If I may, it's not even about buying back stock for the sake of buying back stock. It's reducing the share count enough that the dividend payout ratio is on a bit more of a stable footing. So the interest expense is one flex item to defend your net income and your free cash flow. The other item is reducing your share count through a big sale, because MLSE, the Leafs, the Raptors, the Argos, FC, Toronto FC, that is, are all trophy assets. They're billionaire cocktail party toys these days. So people weren't buying it for the cash flow. And frankly, what Rogers is probably going to do is spin it out into an SPV and try to consolidate it that way. So it wasn't about the cash flow for MLSE. It was taking that pool of capital you extracted, reduce the share count enough that what was 100%-ish payout ratio is somewhere in the 90s. And then execute well on your costs, manage the top line the best as you can, and that's when you get a reasonable 8% yielding bond that you can go and defend and say that makes a lot of sense. But that's really what we're talking about. It's just the optimization and reducing the share count that is fundamentally important that they missed here.
Of the three big telcos in Canada, Bell, Rogers, Telus, what looks the best to you going forward in terms of business itself?
I would tell you Telus, just because it's the most stable. But generally speaking, and if I may zoom out globally here, the Canadian telcos are in an awkward position. So if you're handicapped, sorry, handicap's the wrong word. If you're constrained with a pure Canada strategy, then you don't have a choice but to look at the telcos because Canada is a very narrow market. But I would tell you, looking globally in our global product, the Canadian telcos don't even register on the radar. So I would tell you,
Interesting.
if I had to, if gun to my head, I'd say Telus, but that's very much picking between several difficult options.
So let's start exploring then the global dividend fund that you oversee.
Yeah.
What's the strategy, first of all, for picking those dividend stocks?
Yeah. And it's really the through line here. What we talked about with the Canadian telcos is we start with the cash flow. We start with understanding the fundamentals of the business. And the way we do that is we basically go step by step through the value chain. So we take a product or a service and we deconstruct it up and down from where they are to make sure that the company we own has a right to win over the foreseeable future. And usually what that means in terms of output is strong growing cash flows, a dominant market position that's getting better as they're taking price on customers and they're taking more margin from suppliers. So they're expanding their share take, and that growing cash flow and free cash flow is what's driving a higher dividend growth rate and a dividend payout ratio, if it makes sense. And some businesses are very capital intensive, and that's okay because the returns are good. Some businesses are not very capital intensive, and they can grow without needing capital, but those tend to be fewer and further between.
So which means like you're not out there hunting for the highest dividend yields. You're looking for growth, dividend growth, right? And that could mean yields between, let's say, 1.5% and 3 and 4%, right?
Yep. And some could be 0.5s and some could be 7s.
Yeah.
And there are quality 7s out there. But you have to acknowledge that the growth rates of those companies are fundamentally in a different place.
It's a trade-off, right?
We put all those together in a big cauldron and
Yeah.
then spits out a yield that's competitive, but a dividend growth rate that is also competitive.
So tell us, Dan, about some of those highest weighting holdings in the global dividend portfolio.
Yeah, so I'll tell you one of the elements that we really like is we like toll road type of businesses. And I don't mean physical toll roads, which are okay too, by the way, as long as the concession is very long, just like the 407 here in Toronto. So
Toll road in the way that Warren Buffett would describe it, right? Basically. So please go into it. Yeah.
Yeah, so a perfect example of a company like that is called TransDigm. So what they do is they tend to do more special dividends as opposed to a really competitive annual yield. So what they do is they're an aftermarket parts supplier. So they sell to the original equipment makers, the airframers, in this case, the Boeings and the Airbus, but those are really at cost or at a marginal loss. They make their money in the aftermarket. So we're talking seat belts, bathroom doors, latches, low value, but spec'd in products on the plane. And the market as a whole is actually growing. So believe it or not, air travel has been a consistently growing industry because we've gone from what's known as the the hub and spoke model to the point-to-point model. The point-to-point model is if I want to go take a flight from Toronto to Frankfurt, I can do that today more so than I could have done 10, 15 years ago. Before, you might have had to transit through Chicago on your way to Frankfurt or transit through Heathrow in London to get to Frankfurt. But now, if there's enough load capacity and other people who have the same mindset as I do, we want to go to vacation in somewhere in Germany, we can take a direct flight there. So what that does is it opens up many more permutations of routes that are available point to point than before, and it avoids the congestion that hits the major hub airports. So that allows for more air travel to happen in general. So it's market expansionary. So then you ask yourself and say, well, basically airline service miles have grown even through the financial crisis outside of COVID, which was a truly idiosyncratic exposure that hit them. So airline travel is secularly growing. Great. How do we participate in that in a way that makes sense with our philosophy? Boeing and Airbus are dominant in duopoly. The Chinese Comac isn't really going anywhere, and Embraer is too small. So they kind of own the wide body and the narrow body market. But the issue with Boeing and Airbus, it's kind of like the automakers. You know, I grew up in Whitby, Oshawa. It's a big car town. There's many more stakeholders than just profit when it comes to the airline company, airframers. So Boeing has to deal with suppliers, 10,000 of them. If there's a latch missing or a screw missing, you better believe that production is going to grind to a halt. So building planes and assembling planes is hard stuff. Flying planes is tough too. If you're Air Canada or United, we're in a bit of a sweet spot right now in the cycle where capacity is coming out. But through a full cycle, airlines are capital intensive. Their revenue is pre-booked early with the extended elongated booking curve, and their costs, they need to match up the hedging, but that's not always practical or cheap, let alone the fact that they might be wrong on their capacity, their type, and there's the inventory flying away and never coming back. So the foregone revenue if you're not hitting full occupancy. And the prisoner's dilemma on competition on regional routes that happens there. My point is it's hard, it's complicated, and it's tough to run that business consistently with peak margins. But that's not true for the aftermarket. You can make the life jackets that go into the plane, and they'll be spec'd in as long as that narrow body or that wide body plane is flying for the rest of its life. And you can, if you're sole source or dual source on it, you have pricing power. So you can take price up and manage downturns in the cycle because the airlines will just pass it on. And because it's uniform, the whole cost structure for air travel goes up, but you're doing it on such a small value piece that no one even notices. So you're hiding in the cost of goods sold for the airline ticket. So that gives TransDigm the opportunity to grow, compound at well above airline travel growth rates with consistent pricing power, and it generates excess cash flow. So they give it back to us in regular dividends, but more attractively the specials when they don't have a good use of capital, where they're not buying more parts and more spares that's already spec'd into a plane. They're giving it back to us in special tips. So we like that type of situation, and it's just a microcosm of how you can participate in a growth industry, but in the right pinch point in the value chain.
Interesting. So it's almost similar to someone who doesn't want to invest in oil and gas producers, but there's also oil and gas service companies that service the producers that aren't as cyclical or correlated to the booms and busts. So tell us more about what excites you in terms of the holdings, Dan, in the portfolio, the global portfolio.
Yeah, I'll tell you as a whole, and when we look at these companies, it's not necessarily about is there a major theme that we're very excited about, or is a very nuanced, salient effort that we're overly concentrated in. Our goal is generally to be quite diversified and find many different ways to win. But I'll tell you, one of the areas that is seeing a renewed level of growth is, and I'm sure this gets talked about a lot, but there's other ways to participate. So when we're seeing the build out in the US, we got to appreciate that it's not EV plants, battery facilities, and all of that. We have it in our mindset that we're building metal bending facilities all around the US now. It's largely electrical, and it is largely focused on the data center market. So the US is seeing an industrial renaissance that is by and large focused on the data centers. And there's opportunities in that because you don't always just have to own NVIDIA or Avago in the portfolios. And I'm not saying those are bad. Those are perfectly acceptable. And we have Avago in the portfolio and have owned it for 10 years. But when you come to how the data center is built out, there's a lot of aggregates, construction materials, low voltage, medium voltage, transformers that are needed as well. So whatever's around the data center can play just as powerful of a role in terms of building it out. And there's ways to participate in that. So I think the industrial reshoring that's going on through electrical is a powerful multi-year theme. I also think that when you think about more bellwether industries and sectors, think of the waste sector. They're regional monopolies, they're in industrials, but it's a nice barbell from, call it the risk-on, pro-growth, pro-AI trades that are going on in the market that come with electrical. Waste is long cycles, slow, and they tend to have pricing power because you own the route, and the municipality doesn't quite know if it's the tipping fees, if it's the landfill fees, or the freight, or the labor, where the cost structure consistently is going up. So being a full stack player like Waste Connections is a great way to participate in a more defensive long cycle industry like waste.
How about companies that participate in data center buildouts? Yeah, Dan, the data center buildouts. If you have some companies in the fund, it'd be good to hear about those.
Yeah, one example, like I know Eaton gets brought up a lot, but there's actually a European example called Schneider Electric. We don't own it in the portfolio just yet because we've expressed it in a slightly different way, but Schneider is always on our watch list. So they're a diversified electrical components company, but it's medium and small and medium voltage transformers is where they focus on. And those basically are all around the data center that interconnect the data center outside of the pure optics between the chips itself. So what used to be an industry that would grow a few % a year would participate in automation and other, call it general productivity improvements around the world, has seen a step function acceleration in its growth from low to mid-single digit to 8, 9, 10% as we look forward. And spinning up these supply chains can take a long time. So we don't want a short cycle winner, because managing through that means getting the right beat, the last beat, the last beat, people start pricing in the next cut, things like that. So when we're owning something for 5 years, you want long cycles with long timelines before supply side responses happen. So electrical components are a perfect expression of that. You can look more domestically at Eaton, but I think Schneider is a more diversified global play because they have more of an international footprint, but also dominant in the US as well.
Yeah, there's so many quality cash flowing businesses worldwide outside of Canada, and you made mention of this, but in the global portfolio, what would be that sliver of Canada in the global portfolio, the piece of the pie,
You know what's
as a
funny?
percentage? Yeah.
Yeah, it's about 5%, and it's not really going to go much higher than that. It might go it'll really depend, because we don't care about being neutral to Japan or the UK or anything like that. We just want to find the best companies. But I'll tell you, in Canada, there's a cross section that we can say are high quality capital allocators. So think of your Couche-Tards of the world, your Waste Connections of the world, and then think of the energy patch in Alberta, which we're not energy bulls, we're not resource people at our core, but at the end of the day, long life assets, midstream assets that are irreplaceable are naturally fitting with what we're looking for. And CNQ and Enbridge are the two names in Canada that we own. And Enbridge we own because it's a quasi-utility, and CNQ we own because it's the highest quality oil exposure that we can find, because they've got they have the right to win to consolidate the basin. So they get all the calls that they want and can pick up the phone and answer when they think it's appropriate or not. But they have a cash flow policy of returning the capital back to shareholders after they've delevered. So we like the fact that the resource base is stable and growing, but more than that, we like the fact that they're not committed to always drilling no matter the price. They're here to give it back to us, and we like that. So nothing better than an oil company that actually returns capital.
Okay, so 5% of the pie, and viewers are obviously really curious, probably because we're talking about BCE at the start. Is BCE a component in the global portfolio?
No.
Okay, it's not. Tell
The
us,
business,
Rogers.
the business quality on telcos is there's this dynamic where it's some things live more rent free in our minds than others, and what tends to live more rent free in our minds are products and services we interact with on a day-to-day basis. So we all have our phones. I got mine right
Yeah.
here. Where we're all customers of RBC and the what have you. So that doesn't necessarily mean it's a great business, right? And the issue with telcos fundamentally, and cable companies as well, when there's more than one player in the market, so call it the convergence cable cos, cable and telcos together, if the marginal cost of offering you more data to offering and getting the next subscriber is very low. Because if the fiber plant is already in the ground or the spectrum has already been bought, then it becomes like the airlines, which I described of, if you get the next subscriber, even if they're paying $10, servicing data on a $10 plan might be 10 cents. So it doesn't take a lot to actually service a new subscriber. And then you hit the prisoner's dilemma. If one company decides to go for subscribers, everyone else has to be disciplined and let that company keep taking market share. So when the marginal cost of an incremental growth driver and revenue contributor is almost zero, you need extreme discipline, and rarely do you find extreme discipline. So
How about the Canadian banks, Dan? Are they in that 5% of the global fund?
they aren't, but they would be in the future at the right point and at the right multiple. So actually back in my day, so I have a long history as being a financial services specialist all around the world. And I'll tell you, the Canadian banks stand in unique ground. And what I mean by that is that the Canadian personal and commercial banking market, especially, is exceptionally profitable. Exceptionally profitable. We're talking 30% plus our returns on equity. And the US equivalents would be running 8 to 10 to 12 to 13% at mega scale. So when I worked in New York, I used to joke with my coworkers that, because we used to cover regional banks in the US, and we would say it's a knife fight in New York and it's a pillow fight in Canada. It's very true. And the ironic part about it is the companies that have stayed in Canada are the most profitable and have had the fastest book value per share growth, as opposed to, and I'm very critical of TD's strategy, and that was well before the fentanyl trafficking lawsuits and the ransom that was deemed and demanded upon them for good reason. They should stay in Canada. They have a 30% plus ROE business, and in RBC, which has been heavy in Canada and heavy in fee-based income, has done really well. And we're very happy to own it in size in the Canadian portfolios. And same with National Bank, which has continued to grow in the Canadian market. So it's really, when it comes to the Canadian banks, we want to own local and a commitment to stay local. And we want to make sure we time the point in the credit cycle where it makes sense to increase the positions and not. And in the other cohort of companies, your Bank of Nova Scotias, your BMOs, your TDs of the world, and even incrementally CIBC, even though the management improvement has been pretty material there over the past several years, we want to stay in the RBCs and the national banks of the world. But
So
but not at this point in the cycle. So we are in the Canadian banks.
So Dan, your criticism of TD early on, what was it similar to BCE now? They're going in the US and it's just the outcome is lower margins, right? It's just capital expenditures. And what do you achieve at the end of the day? Was that your criticism early on of TD?
Yep. You're taking a fantastic business that has 30% plus ROEs, and you're diluting it to build scale over decades and tens of billions of dollars of capital to invest in a business with an 8%, 10% ROE before you include the one-timers, the fines, the charges, and frankly, the regulatory headache and the distraction. So once again, they'll tell you, well, look how many ATMs we have, look how many branches we have, look how many customers we have. And my point, part of my language would be, I'd say, cool, but your ROE is still 8%. So just buy back stock. You might trade at 2 times book value. You might have a 20% ROE at a group level through the cycle. That's a 10% implied return right there. So, if you trade at 10 times earnings, then you don't need to allocate capital down south. You can just buy back stock and save yourself the trouble. But the allure of the big blue ocean that is the United States has been a huge, huge, huge issue for TD. And if we run the counterfactual scenario of what if TD had just stayed in Canada, shareholders would be shocked at how much potential return we missed out on.
There was a time years ago when tech companies would not pay a dividend, right? There's plow the capital back in the business to grow. But now we have these mega tech companies that basically, all pay a dividend. Which ones are in the portfolio, the global portfolio?
So we like to think of it as a spaceship. So think of them and think of going through high school into university and finally growing up. So in the early days, Meta is actually a perfect example of this. It was Mark Zuckerberg at the IPO. He came in hoodies and I think he was just past being a college grad. So it's not surprising. So he grew up, the hoodies then turned into suits after Cambridge Analytica and the firestorm that came there. And now it was Zuckerberg refocusing because the threats on the business started to pick up, especially with TikTok, which is owned by ByteDance, and it had the scale from Douyin out in China already. So you saw Meta's transition from hoodie to suit to optimizing the business, running for efficiency, running for cost, no longer blindly investing in any moonshot project, to then finally paying out a dividend after they had already started buying back stock. So it really starts with the maturity of the business and the margin profile. And the ideal phasing is you want to catch them as they're climbing the S-curve on that, where the revenue pie is accelerating and climbing as it should, but the cost structure is being optimized. So you get the incremental margin expansion and the free cash flow wedge, which then gives you so much cash flow that you have no choice but to buy back stock. And eventually you don't have a choice but to introduce a dividend. And I believe Meta's going through that curve now. Google is as well, even though the capital intensity is rising. Amazon in the next few years will have no choice but to pay a dividend and buy back stock, even though they're the last real holdout. And then it just goes back to NVIDIA's there, but it's a very different conversation because it's a super cycle on a single product cycle. And Netflix is a bit more different because it's very capital intensive, and so is Tesla. So I would just say, don't put all the big, what used to be called the FANG stocks in one big pie. Put Apple, Microsoft, Google, Facebook, or Meta, and Amazon in one group, and take the Netflix, Teslas, Nvidias of the world and put them in a different bucket altogether.
How about the old and big like food chains and retailers? I'm thinking McDonald's. Do they have a space in the global portfolio? These are pretty like predictable cash flows, right?
They do at the right point of the cycle. So I can go sort of one by one on some of these companies, but if you take McDonald's as an example, these are great financial business models and great dividend compounder models, assuming the algorithm is robust and stable with an upward trajectory to it. So McDonald's is perfect because it's franchise, so it's not capital intensive to grow. The same thing's true for Domino's. And if you want to go really early stage in this conversation, a Wingstop, but we're talking 200 times earnings, the store count has to quadruple, all that type of stuff. So I just want to tell you there's a journey that comes here. McDonald's is the most mature in that journey, along with Yum Brands, and the Wingstops of the world are the new concepts that are scaling. But it's capital light to grow. You get the comp, and the franchisees, you push the new Sunday machine, the new smoothie machine. They're the ones that are forced to pay, but they're still happy to pay because their their margin structures are decent as well. So yes, they're great business models, but the issue with a company like McDonald's today, even Starbucks now, we're not big fans of retail. And we don't have any positions there right now, and including in restaurants, because McDonald's has taken too much price. So they've taken COVID and the food inflation, the food away from home inflation that is, and taken price on the back of that. And now consumers are substituting out and staying more food at home and basically downtrading, believe it or not, from McDonald's. So McDonald's has been taking price, but their traffic's been tipping negative. So you want ideally reasonable price taking and reasonable traffic growth to have a stable compounding dividend growth model. But when they get the right formula set up, I absolutely would be excited to own McDonald's at the right price too.
Yeah, there's blogs out there, right, Dan, that basically track how long a company has been paying dividends. Does longevity matter to you?
It does, as long as the longevity is not driven by incrementally higher payout ratios as the priorities of the company change. So there's a lot of companies that are now fallen angels that used to be viewed as dividend stalwarts or dividend aristocrats, as they're known. And one example that lives honestly in my mind all the time is Intel. Intel was a consistent dividend grower, dividend payer. The only issue with that was they were losing data center market share and design. They were basically falling behind on Moore's Law, as it's known, to Taiwan Semiconductor. So you can focus on increasing your payout ratio, trying to get grants from the government. But if you're behind on the technology, eventually that catches up with you. So that the same is true for probably what became IBM's mainframe business that started tipping negative and hurt their cash flow profile. So IBM used to be one of those companies. We don't even remotely, that doesn't enter the conversation at all these days, but years ago that was the case. The same was true for Intel. And we're also there's other companies that are going through their own trials and tribulations now. So those are just tech stocks that they're now in the wrong phase of their terminal value discussions. But take a Nike as an example. Premium brand, but their core markets they were losing share on. So what are historically long-term dividend growers, ultimately, if the fundamentals, they're losing share on their core businesses, it's a matter of time before the dividend payout ratio comes into the discussion, and then the dividend cut comes into the conversation. And I would always say, I never want to be surprised by a dividend cut. I want to be prepared because I saw it coming years down the road.
And so,
Rarely
what
does
would you say is a comp?
tip so aggressively, so quickly, and that
Yeah,
only happens when you do a major transformational deal that doesn't work out.
yeah. What would you say is the composition of industries in the global portfolio?
It's call it about 15-20% in the major sectors. So think of your technologies, your healthcare, your industrials, and financials. We own a bit more in financials because we really like the exchange space because they tend to be natural monopolies. So we own a bit more on the financial side. And we actually own a little bit more materials than you would expect, but that's not because we like BHP Billiton or Agnico Eagle in the global portfolio or anything of that sort. We actually own companies like industrial gas, packaged gas, and increasingly looking at the paint companies as well. So we own industrials that are misclassified in my view as material stocks. So it tends to be pretty blended and diversified. And the core point we always say is you don't want one theme and one idea to dominate and risk the entire portfolio. because we want to be lower risk. We want to be, your sleep at night allocations. So implicit in that promise is diversification, and we're proud to do that.
How many holdings are typically in the portfolio?
40.
40. Okay.
Yeah.
For the do-it-yourself investors watching this, Dan, there's something out there called Beat the Dow. I think there's something equivalent in Canada, Beat the TSX, whereby every year at the end of the year, which is coming up, you would just select the top 10 dividend yields from the TSX 60 or from the Dow 30, and then just repeat that every year. You just buy into the top 10 yielding companies. What's your take on that strategy for the do-it-yourself investor?
I'll tell you, it's I haven't looked at it too deeply to be honest with you, but I would also say when you look at the top 10 companies, it's basically an implicit bet on the past returns or a predictor of future returns. So I'm sure there's other situations like this where it's ended in tears and no one's paid too much attention to that. So I'd say it's a magnification of what is a trend that seems to be persisting for now. But this is the first time I'm hearing about it, to be honest with you.
Okay. Why would you sell out completely 100% of a position out of the global portfolio?
It fundamentally comes down to, is this the business that we thought we were buying? And I think it's important to understand there's this concept known as thesis drift, which is you bought what you believe was a paint company, and before you know it, they're producing glass bottles, as an example. That's just a hyperbolic example of that. But you want to own the company for the right reasons, and you want to make money for reasons that you believe are the case. Otherwise, you're throwing darts at the board. So that is fundamentally the reason we look at is if we have thesis drift, and the thesis drift is clear and persistent and negative, then we need to ask ourselves, does this make sense? And has the fundamentals of the business changed enough that it warrants selling the position? And usually the answer is yes. Because when you have thesis drift and it's in the wrong direction, it's not because a management team found a fantastic opportunity in a big blue ocean that we didn't know about. Usually, like the Bell example we talked about earlier, it's because they panicked, they got scared that the domestic market's slowing, and they overpaid for a U.S. asset. So you want to own a company for the right reasons, and that is an important part of the sell discipline. The second part is your job as part of a diversified portfolio is to optimize with the best opportunities. So time-weighted return and money-weighted return can be improved upon if you are buying more at the right times and selling more at the right times as well. So optimizing for what we think are the best opportunities today is incremental to the man overboard or the thesis drift moments.
Can you walk us through the most recent addition to the global portfolio? We just want to understand your process basically from start to finish.
Yeah, actually one example, and this is a good example of why geographic constraints don't mean what they used to. We actually bought a company called RELX Corp, and it's a company that owns LexisNexis. So if you're driving at the 400 and the 401, just go a bit north on the 400, and you'll see that LexisNexis building there. It's owned by a UK company called RELX, and they own the Lancet. They own the journal that the show Grey's Anatomy was based on. So think of them as a data archive for medical, academic, and legal journals and publishing. So they're the repository of all that, and they build modules on top of their data set, and they resell it back to the lawyers and the academics and what have you. So that is core and foundational to their business model. So we already like that business. We love businesses like that. We love credentials, we love databases, and we love naturally monopolistic businesses. But what's interesting about them is the small language model idea is really starting to take hold, and they can be a direct beneficiary of that. So they can build analytics that use very simple AI, what we call AI now, type of models to build capabilities that lawyers can use to basically, take a few less hours from the paralegal, which is more expensive than getting a small language model doing the work for you. So RELX is seeing accelerating growth, especially in its legal business, because they're giving value. They can take price on the back of that, and they're disrupting what is generally a very people-intensive business in the legal world. And you're seeing an accelerating top line with margins that flow through clean because RELX is a very stable market structure, and you have capital returns on the back of it. So that's a good example of a company we actually just added to in the last 2 months for the first time in the portfolio. And it was because we liked the stock in the first place, but the AI incremental additions only make it better. And in a clear, demonstrable way. Not in the we'll be challenging the Klingons for interstellar domination in no time once AI becomes, everything that Elon Musk is talking about.
Perhaps in 100 years, right? When we're
Perhaps, yeah.
long past. So tell us, in a declining interest rate environment, obviously more rapidly declining in Canada than in the U.S., what's the dynamic for dividend stocks, good or bad?
Generally speaking, good in Canada, but you have to understand that it's the why on why rates are falling. It's not in a vacuum. The Canadian backdrop is more vulnerable than the US backdrop. So that's why the interest rate differentials have been starting to blow out. The same way Chinese and US interest rate differentials are in a far worse place. So the Chinese 10-year bond is at 1.7%. It's down almost 60 basis points in the last 3 months. So, what Canada is seeing is not particularly unique, but it just tells you that the US is a relative haven of growth and resilience in a world that is slowing down more so than people might imagine. What that means in Canada is the interest rate paradigm is lower. And I always say, we're used to a 4 or 5% yield environment on the short end of the curve. Don't be surprised if it's sitting around 1, 0, 2. 0, 1 to 2 is probably a reasonable place to be as we look forward. And that's to bail out people who might be over leveraged in real estate across the major metro areas. So yields going down in an all else equal environment is good for dividend yielding stocks because short-term government bonds that are paying you attractive yields is a direct competitor to dividend paying companies. So if you own the right dividend paying company that isn't exposed to the headwinds that the Bank of Canada is worried about, then I'll tell you, you know what? It's a net benefit. But in other situations, it is potentially a bit more of a neutral conversation. So you get the tailwind of the interest rate cuts, but you get the headwind of the fundamentals getting incrementally worse.
Yeah. So we talked about telcos in Canada, banks in Canada, oil and gas, but we left one off the table, REITs. What's your take on REITs?
So in another world, before I became a portfolio manager, I was also a REIT specialist as well. I'll tell you, Canadian REITs are in an interesting and difficult spot generally. So that doesn't mean you can't be selective. Doesn't mean you can't find the right opportunities once in a while. But generally speaking, we actually own 0 REITs in the portfolio, the global or the Canadian fund. And the reason for that is, generally speaking, the cap rates are either very tight for attractive asset classes. Cap rate is just a way to turn a REIT asset into a bond-like equivalent yield. So it's just easier to compare. Multifamily was attractive, but it's less attractive because of the potential for population declines as we look forward in Canada or a slower amount of growth. So multifamily historically was a storied asset class, and I would tell you for good reason, because it was supply constraint, and still is. But the top line reason for why rents were inflating is moving in the other direction. Office is in an interesting spot. Retail is actually more resilient in Canada than not, and especially grocery anchored retail. So I would generally be a fan there, and I would start there first because Choice Properties is, that Lovelaw's foundational footprint is strong. So REITs is not something we own today, although I can thread the needle and say some areas are better than others. But you got to take a really big step back and remember that the Canadian pension market is very focused on real estate. So it's not about RioCan, Choice Properties, and Canadian apartment properties, picking the best assets in their sandbox. You got Cadillac Fairview that could buy it all. And they do. So trophy real estate assets in Canada are realistically owned by the major REITs, which are the pension-anchored REITs. And that means that you're stuck with what might not be the best assets or what might be riskier development to actually build the next trophy asset. So I think the Canadian REIT picture can be tactically interesting, but generally speaking, we avoid it.
For the listeners just wanting to start out with, a $10,000 dividend portfolio for the first time, how do they go about it?
Don't start with one stock. I think the most important lesson for everyone from a very early day is don't look at, and this is actually from a different generation. Like I come from a generation where retail and day trading and influencer marketing has taken off in a way that's very different than generations before me. So the access to information and the democratization of information, I think on balance is a phenomenal positive for society. But that also should be taken in stride to say diversification is not NVIDIA, Tesla, and some crypto. And that is usually most people's starting points, you know? It should be start with a dozen stocks, do the research, use the public tools available, like part of the conversation we're having right now. Get the insights from many different places, and then really try to learn and understand the deep details about the job and what that job is for professionals like myself who do this full time. So the information is available, it's public, it's all there for everyone to see, but getting that insight means really rolling up your sleeves, starting with the basics. If that means reading The Intelligent Investor and Security Analysis, I don't think that's a bad starting point. But there's so many other ways like YouTube, like what we're on right now as a platform, to really get access to a shortcut of that. But build that base and don't start out with a handful of stocks, because if that experience goes the wrong way, then you'll never look back. And you know, you might be in GICs forever. And that's not a good decision for a young investor or even a middle-aged investor. And if you do really well on overly speculative stocks, you might go too far and overcorrect in that direction too. So start out with, call it a dozen that you can diversify along by several different sectors to build that footprint. So I'm actually encouraging everyone to do more work than just start out with a handful of stocks that you like and the product or service that you're a fan of, and just force yourself to really build out a diversified portfolio and use the public tools available to you.
What would you say, Dan, to someone who said there's a trade-off? If I invest in dividend companies, I'm not going to be seeing the same capital appreciation in my portfolio. What would you say as a rebuttal to those people?
I tell you, it all comes down to perspective. If you're buying 8, 9, 10% yielders and that's the entire portfolio, then I wouldn't expect a lot of capital appreciation because, you know, and this is a broader part, like where we are in the market today, Robin. It's, you know, investors are, even after what was, generally speaking, a rough day in the markets yesterday with the Fed doing a hawkish cut, we're still having one of the best years in the last 26 years.
Tell me about the year that you're having right now.
Yeah, across the board. So whether it's a dividend fund, whether it's a growth fund, whether it's any of the types of products that are available to people, it's been very, very strong. So if you're getting 7, 8, 9% over time per year, that's a very good number. So a high yielding dividend company is actually giving you an annual equity markets expected return with, you know, as long as they pay the yield and the stock doesn't go down. In the case of BCE, that's not the case. But normally that is, you know, that's, call it a job well done and a day's good work. But I would tell you, we don't need to have 8, 9% yielders in the portfolio as a foundation. Blend in 1, 2% with the 3, 4, 5s and build a portfolio that has consistent growth. So you're going to get a few percent from yield, and you're going to get more from actually capital appreciation if it's the right business model too. But it's about that consistency. But I think the starting point today is really important to say, don't think 25% is normal.
Absolutely not. How has your year been for the global portfolio? If you can talk about returns and reflect.
Yeah, it's something I think about because we tend to do a lot of engagement with clients, and even the LinkedIn blogs are a perfect way for me to just sort of give an open conversation about what's going through my mind at any given Friday. We're up 27% on the year. I would say that's an extremely good year. But you know what's interesting? It's been an across the board asset class rally. So we actually launched a balance product, and that fund is up 22% over the last year too. So whether it's bonds, pure stocks, and high growth stocks, it's been a phenomenal year across the board, which is my job as a risk manager to say, no tree grows to the sky. So I know we gave you 27% so far this year, but just know that long-term, plan your life for 6, 7, 8%. So we've had a pretty good year. I'm pretty happy about that. The capital appreciation was a far bigger driver than the yield. So, but that's not true for every single year. But I would expect a balance of 1/3 coming from income and 2/3 coming from capital appreciation in a normal environment.
What about favorite books, Dan, that you've read that got you into investing early on?
You know, it was a lot of the basics, but actually I'm a big fan of podcasts. I'm a big fan of actually call it the anecdotal reading. So I'm a big Substack believer. I'm a big believer in actually formats like this. So it's not necessarily about the books, because I've read the Warren
Yeah.
Buffett Way, Security Analysis, all the stuff that fits most people's bookshelves in the back. But I'm a big podcast guy. So think of Invest Like the Best is a great example of, and the Acquired podcast, where if you want a 6-hour deep dive on Standard Oil, that's the place to go. So
Yeah.
building that mosaic of information, I think, is far more important than taking one or two books as dogma and then building your career off of that. So
Podcasts are the way. You're like
I'm
right now, right?
a biggest reader.
We're making history right now, right, with
There we go.
BCE
Exactly.
and the global portfolio. So thank you, Dan, so much for being on the show. I really appreciate it.
Thank you for having me. Appreciate it.